Chapter 1, Introduction to Accounting and Business. If you will, take a moment to turn to page 25 and 26 in your textbook. We are going to work the illustrative problem. And while I'm working it, I am actually going to explain each transaction to you. On page 25, the illustrative problem begins. Cecil Jamison, attorney at law, is a proprietorship owned and operated by Cecil Jamison. On July 1st, 2013, the company has the following assets and liabilities: cash, $1,000, accounts receivable, $3,200, supplies, $8,500, land, $10,000, accounts payable, $1,530. Office space and office equipment are currently being rented, pending the construction of an office complex on land purchased last year. Business transactions during July are summarized as follows. And then there's transaction A through K. So we're going to record those transactions in the grid that looks similar to this. This particular format for recording transactions as they relate to the accounting equation is only in Chapter 1. This is just so you can understand how recording a transaction affects each account and also affects the accounting equation, assets equal liabilities plus owner's equity. We know that assets are things that we own or the company owns that offers a future benefit, such as cash, accounts receivable, supplies, land, vehicles, buildings, things like that. Liabilities are items that the company owes or debts that are owed. And we've got accounts payable. We could have mortgage payable, wages payable, taxes payable, any type of payable, unearned revenue, things like that. Owner's equity is made up of four separate accounts, or four types of accounts: capital, drawing, revenue, and expenses. Okay, so capital and revenue increase equity, drawing and expenses decrease equity. So we add in capital, take out drawing, add in revenue, take out expenses, following along with the plus, minuses, and things like that. All right, so it says we started off with $1,000 in cash. Now we had accounts receivable of $3,200. There were supplies of $850. Land was $10,000. Accounts payable is $1,530. And the capital, which is CJ Capital for Cecil James, is $13,520. So our assets equal our liabilities plus our equity. All right, so we're going to begin with transaction A. That states, receive cash from clients for services, $3,928. I want you to start thinking about each transaction that you read as two separate sides of the fence. The first thing you need to evaluate and analyze is, what did the company receive? What event happened? What took place? Then you need to look at how or why that particular event happened, or how did the company get what it received. So once you think of it that way, it's a little more easier to tackle how the transactions affect the equation. So it states clearly, we received cash from clients for services, $3,928. So I automatically know I'm going to enter $3,928 in the cash account, resulting in a balance of $4,928. Then we have to determine how or why did the company get this? Well, it says clients for services. Receive cash from clients for services. That means that we earned some revenue because we did some work. So we're going to add $3,928 to the revenue account. We're also going to bring down the balance for the accounts that we did not use. So we've balanced. Cash has $4,928. Accounts receivable has $3,200. Supplies has $850. Land is $10,000. Accounts payable $1,530. Capital $13,520, and fees earned, $3,928. So then we're going to look at transaction B. Paid creditors on account, $1,055. Okay, well, what event took place? The company paid a debt. How did the company pay this debt? They took the money out of the cash account. So we're going to take $1,000 away from cash, and we're going to take away $1,000 from accounts payable. We now have a balance of $3,928 in the cash account, $3,200 for accounts receivable, $850 for supplies, $10,000 for land. The new balance for accounts payable is $530. CJ Capital, $13,520, and the total revenue earned for the month so far is $3,928. Our assets equal our liabilities plus our owner's equity. Now we're going to record transaction C. Receive cash from Cecil Jameson as an additional investment, $3,700. Okay, so Mr. Jameson invested money in his own business, and that results in capital. So what we need to do is we need to add to his capital, but we also need to add to the cash account because he put $3,700 in cash in the company, and we're going to increase his capital by $30,700. So now we have cash of $7,628, accounts receivable $3,200, supplies $8,500, land of $10,000, accounts payable $530. The new balance in capital is $17,220, and the total revenue earned so far in the month is $3,928. Now we're going to record transaction D. Paid office rent for the month, $1,200. Okay, well, they've told us what happened. What happened? What event took place? We paid the rent. So we have to determine how did that particular event happen. Well, generally when you pay a bill, you're going to pay for it with the cash account. So we're going to go ahead and deduct $1,200 from the cash account. And we're going to go ahead and enter right here a negative $1,200 for rent, because we want this to show as a negative amount, because remember, expenses decrease equity. So we want this to show as a negative. All right. Then we bring down the balances for accounts receivable, supplies, land, accounts payable, capital, the revenue. All right. Transaction E. Charge clients for legal services on account, $2,025. Okay, when we do work for a client and we allow them to pay us at a later date, we in essence consider this billing a customer, charging a customer, or creating accounts receivable, because that is what accounts receivable is. Invoices that you have sent to your customers for work that you have completed but have not yet been paid for. So, looks like in transaction E, they billed customers for $2,025. So we're going to increase the accounts receivable account by $2,025. And we're going to go down here and we're going to increase revenue by $2,025, because that's how we earned that particular amount of money. Accounts receivable $2,025, revenue $2,025. Then we see our new balance in accounts receivable is $5,225. And now we have revenue so far for the month of $5,953. And then we're going to bring down the balances for all the accounts that we did not use in this particular transaction. Very important that you bring the balances down. Transaction F. Purchase supplies on account, $245. I want to caution you right now with the fact that there is a supply account under assets and a supplies expense account under owner's equity. Remember that when we purchase supplies, we hold that amount as a supply for asset, and then when we use it, we will convert the amount we used to supplies expense. Be very careful with this. Commonly done incorrectly out in the real world. Supplies are bought as an asset, and when we use them, they become an expense. All right, so transaction F, purchase supplies on account, $245. Well, we know that we're going to increase supplies by $245. Then it says we purchase supplies on account. Well, I want you to think of that when it says on account for things that we're buying. Basically, we said, hey, thanks for the $245 in supplies. Send me a bill, which becomes accounts payable. So we're going to increase accounts payable by $245. The new total in supplies is $1,095. Accounts payable has $775. Then you need to bring the balances down for all the accounts that we did not use in this particular transaction. Transaction G. Receive cash from clients on account, $3,000. All right, well, they told us you received $3,000 in cash, so we're going to go ahead and record $3,000 in cash, increasing the cash account. Then it says receive cash from clients on account. Well, earlier we had a balance of $3,200 in accounts receivable, and we increased it by $2,025. We now have a balance of $5,225 in accounts receivable that represents the amount of money that clients owe us. When we bill them or charge them on account, we create accounts receivable. When the transaction reads received cash from clients on account for $3,000 or for however much, you're going to reduce the accounts receivable account by that amount. So basically out in the real world, this would be, we went to the mailbox, we opened up the mailbox, there was a check for $3,000, we put it in the account, and why did we receive that money? Because some of our customers paid us. So now we have $9,428 in cash, $2,225 in accounts receivable, and then you bring down the balances for the accounts that we did not use in this transaction. Let me go ahead and explain that it is very common for people, when we read this particular transaction, receive cash from clients on account, that you're going to want to go back to the revenue account and record that $3,000 there. Do not do this if it says received cash from clients on account. You've already recorded the revenue in a previous transaction, and then you applied it to accounts receivable because you did the work for revenue, but you billed the client to create accounts receivable. And so when we receive cash from clients on account, it is the accounts receivable that is going to be reduced, and the cash account will be increased. Transaction H. Received an invoice for paralegal services from Legal Aid Incorporated for July to be paid on August 10th, $1,635. So what we have to decide is, how are we going to record this to be paid at a later date? Well, we already know that we received a bill for $1,635 as it relates to legal expense. Then we have to say, okay, well, if that is the event that took place, I received a bill to be paid, but I say I'm going to pay it at a later date, which is going to be next month. We then create what is called accounts payable again, and we add to this particular account the amount of money that we owe for this bill. So this transaction 8, received an invoice for paralegal services, $1,635 to be paid on August 10th, which is next month. We're going to increase the legal expense bill, but we're going to enter it as a negative. And then we're going to do under accounts payable, we're going to increase accounts payable by $1,635. Remember, we're entering this as a negative because it decreases owner's equity. Notice the minus sign here. Decreases owner's equity. You want to bring down the balances of all the accounts that you did not use in this transaction. And then we're going to record transaction I. Transaction I, paid the following: wages expense, $850, utilities expense, $325, answering service expense, $250, and miscellaneous expense, $75. Well, the way we're going to record this is we're going to record it as one big transaction, generally referred to as a compound transaction because more than one thing is happening here. We're paying a lot of bills, but we're only going to reduce one amount in cash. So let's go ahead and enter the bills that we're paying. It states that we had wages of $850. So put that in. We had utilities of $325. We need to pay our answering service $250. And then we had some miscellaneous expenses of $75. Okay, so $850 plus $325 plus $250 plus $75 equals $1,500 that we're going to reduce the cash account by. So we took $1,500 out of cash and we paid the wages expense, the utilities, paid for the answering service, and paid for some miscellaneous expenses. Transaction I. This gives us a new balance in cash, a new balance for wages expense, utilities expense, the answering service expense, and miscellaneous expense. And we bring down the balance for each account that we did not use in this particular transaction. And now we're going to record transaction J. Transaction J states, determined the cost of supplies on hand was $980. Therefore, the cost of supplies used during the month was $115. So let's talk about this. Right now we have $1,095 in the supplies account. And at the end of the month, when somebody went and counted the supplies, they came back and reported, we only have $850 in supplies right now. $980 in supplies right now. So we need to first reduce the supply account by the amount of money for the supplies that we used. And we're going to write that amount off to supplies expense. So in transaction J, we're going to reduce the supplies account by $115 because that's how much we used, leaving us with a balance of $980 as the transaction indicated. And then we're going to take that $115 and we're going to apply it to the supply expense account. Supplies expense. So we reduced the supplies account by $115 and we put $115 in supplies expense because that is what we used. This particular transaction is also known as an adjusting transaction, which means that we weren't purchasing anything, we did not earn any revenue, we did not pay a debt, the owner didn't put any money in, the owner didn't take any money out. What we're saying is that we are adjusting the supply account by the amount of what we used and then converting that $115 to supplies expense. An adjusting entry is what this is called. Bring down the balances of all the accounts, regardless if you use them or not. And then we're going to record the last transaction, transaction K. Jameson withdrew $1,000 in cash from the business for personal use. Well, we know that he took $1,000 out. So we are going to reduce the cash account by $1,000. And when the owner takes money out of the business, we're going to apply this to the drawing account. So we're going to put a negative $1,000 here. And And now we show the cash account reduced by $1,000, and the drawing account now has $1,000 in it, indicating that Mr. Jameson took $1,000 of cash from the company, probably to pay his personal bills. The last thing you're going to do when you're doing these types of formatting for transactions, you're going to balance each account. And if you turn over to page 26, you will see that the cash account should have $6,873 in it. However, I do not have that particular balance. So this is a good example of how we're going to go back and correct and see what did we do wrong. And I already see it right here. On transaction B, I erroneously recorded the wrong amount for the creditors that we paid on account. So I should have paid $1,055 in cash, and I should have taken away $1,055 in accounts payable. My mistake, but fortunately that gives me a demonstration of how to go back and look at the transactions to see how you may have recorded the wrong amount. So let's compare our balances to the balances that are on page 26. We have cash, $6,873. Accounts receivable, $2,225. Supplies, $980. Land for $10,000. Accounts payable, $2,355. The capital account has $17,220. The drawing account has $1,000. Fees earned, $5,953. We had legal expense of $1,635. Rent was $1,200. Wages expense $850. Utilities expense $325. Answering service expense $250. Supplies expense $115. And the miscellaneous expense of $75. So now my assets equal my liabilities plus my owner's equity. We take the total of assets, and I'm going to do this right here for demonstration. My total assets equal cash plus my accounts receivable plus my supplies plus my land. I've got $20,078 in assets, and this should equal my liabilities that happen to be $2,355, and then my owner's equity is going to be made up of the capital minus the drawing, plus the revenue, minus the expense accounts. So we have $17,723 in owner's equity, and we have liabilities of $2,355. So let's add that up. $2,355 plus $17,723. We have liabilities plus owner's equity of $20,078, and we have assets of $20,078. So after all these transactions, our equation is balanced. This concludes the first part of the illustrative problem that is on page 25 and 26 in your textbook. The next video will be a demonstration on how to build the financial statements from the information that we gathered on the balances after doing these transactions.